Hey everyone, Bill Lethman here with Money Evolution. In today's video, I'm going to be talking about 6 types of income that's not taxed in retirement. So, if you've been here on the YouTube channel before, you know I like to talk a lot about tax planning strategies. And in particular, I like to talk about tax planning for individuals that are either retiring or about to retire. So, in this video, I'm going to hit on real quick 6 areas that you may be able to tap into without paying income taxes. But real quick, before I get into the contents of today's video, if you like what we're doing here, be sure to hit that like and subscribe button here to our channel. Also, check out some of the links we have in the description below. So if you'd like to learn more about what we do at Money Evolution, we've got some links to our comprehensive financial plan called Wealth Vision, and also our retirement planning course called the Retirement Time Machine. So check those out down in the description below. Okay, so first on the list is going to be your HSA account or your health savings account. So if you've accumulated some balances in an HSA account, that's going to be one area that you can tap into and take qualified distributions from that HSA without having to pay taxes on that. So what are some things you can use that for? Well, number one, obviously, you can use that for any out-of-pocket medical expenses that you might have. Things like doctor copays or prescription copays that you might have. If you're planning to retire before Medicare, before age 65, you can actually use that HSA money to pay for COBRA expenses. So that's one thing you can do. If you're on Medicare, you can use your HSA account to pay for Medicare Part B and Part D premiums. So that's something you can tap into. And one thing to note, though, is if you're somebody retiring early and you're planning on going on an ACA plan, Affordable Care Act plan, you cannot use your HSA for ACA premiums. So that's something very important to note. One thing that I like to tell people with regard to their HSA is that if you're building up a balance in that HSA and you're investing that, hopefully making some positive returns, you can actually kind of stockpile all of your different receipts that fit into this qualified distribution category, and then you can submit those receipts later on and then get that money back tax-free. So you could have an expense from 2022 and then wait till 2025 or 2027, 2028 to submit that. What that allows you to do potentially is to grow that HSA, hopefully, and get that additional tax-free benefit and take that qualified distribution later. So there's some things you can do there with an HSA. Again, this needs to be looked at within the context of your overall financial plan. Look at what makes the most sense. Whether that's to take that money out sooner for some of those qualified medical expenses or try to defer that and grow that account a little bit. So the second source of money that you may have available to take some money out tax-free in retirement is going to come from your Roth IRA account. Now, your Roth IRA is going to get split really into 3 different buckets or 3 different categories, depending on how that money got into the Roth IRA. So bucket number 1 is going to be your contributions or the money you put into the Roth IRA. Now, a lot of people may not know this, but you can actually pull those contributions out at any age without having to pay any taxes or penalties. So if you put, let's say, $30,000 into your Roth IRA account over, let's say, a number of years, at any point you can pull that $30,000 back out, and you would do that without having to pay any taxes, and no penalty would apply, even if you're under 59 and a half. Now, there's going to be another component to that, and that's going to be some of the earnings that are going to be on those contributions. So let's say you put $30,000 in, but let's say now through some growth in the market, that account's now worth $50,000. So in order to take that extra $20,000 out, it has to be what's known as a qualified distribution. And there's going to be 2 key rules that are going to have to be met in order for that to be income tax free and penalty free. One of those is going to have to be 59 and a half, and we've all heard that age before. And number 2 is you had to have had the IRA account, the Roth IRA, open for at least 5 years. And as long as those 2 criteria are met, you can pull out any portion of that account or all of that account and do that completely income tax and penalty free. Now, the third bucket is going to be on any Roth conversion. So if you took money from a traditional IRA account and you converted it over to a Roth, there's going to be a 5-year rule that's going to apply to that as well for having it be qualified distributions, but it's going to be a 5-year clock that's going to start with each conversion. So if you converted money in 2022, you're going to have to wait 5 years or until 2027 in order for that money to be available for you to take it out penalty free, even if you're over over 59 and a half. So that's something very important. So this is a great source to have some potentially tax-free withdrawals coming out of that account. But if you're putting your plans together and you're doing a lot of Roth conversions, and we've seen this before with people where they convert so much money that they don't really have a lot of options for where they can pull money from because all of it's tied up on that 5-year conversion window. So understand there's going to be a different 5-year rule for your contributions, and there's going to be a different 5-year rule for your conversions, and that's all going to have to be accounted for separately. But Roth IRA, number 2. Now, the third source of potentially tax-free income that you could have in retirement comes from something called the long-term capital gain and qualified dividend tax rate. Now, this is something I've made some other videos about before, getting into a lot of detail, but essentially what you need to know is that if your income is low enough for the year and you have those long-term capital gains, meaning you've held a stock or a security for 12 months or longer and you sold it at a profit, or you had qualified dividends, when that happens, you would actually pay a 0% tax rate on that event. So that's something that you could work into your overall tax planning strategy. So to give you an idea, for 2023, if you're filing a single tax return, you can have up to $44,625 and get that 0% long-term capital gain or qualified dividend tax rate. If we add in a standard deduction, let's say, which is $13,850 for 2023, that brings that total up to $58,475. So included in that, it's not only going to be that capital gain or those qualified dividends, but also any other sources of taxable income that you may have. It could be interest income, it could be W-2 income if you're still working, it could be part of your Social Security benefits. There's a formula for that, but it's basically going to be all of that income together, whatever that taxable income is. But if you're under that level, so if you add in that standard deduction, $58,475, then you would be at a 0% capital gain rate. So you could sell securities. That could be something that could help you to meet some of those early retirement cash flow needs. And again, if you sold securities, let's say you sold securities that had a $30,000 capital gain, that may represent a higher value, might be $50,000 worth of securities, it might be $100,000 worth of securities, depending on how well you may have done or not done with that particular security. But that's something that as you're going into retirement could give you some opportunity to fill up what we talk about sometimes are those cash flow buckets, having some money at the ready to meet some of those cash flow needs and everything. One thing to note also, you may know if you're 65 years or older, that standard deduction goes up a little bit, goes up to $1,500. So for a single individual, that's going to be just under $60,000 of taxable income, and you'd be in that 0% tax rate. So at $59,975 to be exact. Married filing joint, it's $89,250 of taxable income. If we add in your standard deduction of $27,700, brings it up to $116,950. And again, with that $1,500 extra kicker at age 65, brings it up to $118,450. So lots of options there with that. So if that's something that you're in a category where you've got some of those long-term capital gains, that could be something that could work very nicely into a retirement tax strategy. Sometimes what we talk to clients about is sort of alternating their years of income. So some years you may focus on saying, hey, this year I want to really focus on trying to hit that 0% long-term capital gain and qualified dividend tax rate. Maybe other years you're focusing a little bit more on Roth conversions. So those are things that we sort of balance out as we're doing some of our comprehensive financial planning. And by the way, if you want to learn more about that, we've got some links down in the description below for that. Number 4 is going to come from the sale of your primary residence. So a lot of people, as they go into retirement, start thinking about maybe downsizing their house, maybe both in terms of the size of the house, but also the cost as well. And that can be an excellent source to help you fund some of those cash flow gaps, especially in earlier retirement. Well, the IRS allows you to have what's called a primary capital gain home exclusion. As long as you've lived in the house for 2 years or longer and you're single, you can have up to a $250,000 capital gain on that house and not pay any income taxes, even if you're buying a house that's less expensive than the one that you're selling. If you're married filing a joint tax return, that capital gain home exclusion is $500,000. So again, it needs to be your primary residence and you need to have lived in that house for at least 2 years or longer for you to qualify for it. But again, that's something else that can work into your retirement plans. Number 5 is going to be any after-tax money that you might have inside your 401k plan. Now, this is something we've talked about before in some other videos, usually in the context of what's referred to as a mega backdoor Roth strategy. So if you have money that's in one of these after-tax accounts, one of the things you can do is you can roll that over to a Roth IRA, either doing that as an in-plan conversion, or you can roll it over to a Roth IRA account. And if you're just moving those contributions, there's no tax on that. Again, we've made other videos about that. There's a lot of considerations that you need to keep in mind there. But another option that you have with that money is at the time of retirement, if you're rolling that money out, you can pull those after-tax dollars back out because you've already paid taxes on that. You can just get a check for that. There's no tax on that. There's no penalty on that. And there's also no age requirement on that as well. So the 59.5 rule wouldn't apply there. So if you're mapping out all of your cash flow needs and your financial plans, and you say, hey, that money that's in that after tax, that would be very useful for my cash flow, then you can pull that money out and there's no taxes on that as you go into retirement. Number 6 is going to be Social Security benefits. Now, I really kind of hesitate to even put Social Security benefits on this list of potentially sources of tax-free income because I do think that most people will end up paying taxes on their Social Security benefits. But I thought I'd mention it here because if your income is low enough, then you technically could end up in a situation where those Social Security benefits could be tax-free. But those thresholds are very low. And that's because those thresholds were actually put into place, I think in the early 80s, 1981 or 1982, and they've never actually been adjusted for inflation. So for example, for a single individual filing a single tax return, if your income is between $25,000 a year and $34,000 a year, then 50% of your Social Security benefits are going to be subject to tax. And if you're over $34,000, then 85% of your Social Security benefits are going to be subject to tax. And that's going to be something called your combined income, which is going to be your adjusted gross income. So that's the gross amount of all of your income before any deductions are coming out of that, plus any non-taxable interest, so like municipal bond interest, for example. And then they're actually going to add back in half of your Social Security benefits into that formula as well. So that's a very low threshold. But again, I mention it here because some people, depending on what you have, you could end up in a situation where those benefits could be tax-free. Married filing jointly, it's not much better. It's between $32,000 and $44,000 a year. You would have 50% of your benefits subject to tax. And if it's over $44,000, then 85% of your Social Security benefit could be subject to tax. So I mention it here almost because some people may think, hey, you forgot about Social Security benefits. Why didn't you put that on the list? And like I said, in reality, I think most people are going to end up paying some taxes on those Social Security benefits. So there you have it. As you're planning for retirement, these may not be the only 6 categories that you could tap into. I thought these were 6 of the most common areas that you could tap into to get some either tax-free income or sources that you could tap into that wouldn't cost you any income taxes. So that's it for this video. Again, if you like what we're doing here, please hit that like or subscribe button. It really helps us to get the views out there to other people. And if you're interested, check out some of those links down in the description if you want to learn more about our comprehensive financial plan or our retirement planning course. We've got some links down there for that. Thank you, and I'll see you back in our next video.